I'm going to talk about stop losses and if you should use stop losses when investing into the stock market. Now, the reason why I thought this video is because I saw a question basically being asked about if a stop loss is good, and the question is, what's a good stop loss assuming that you are mostly trading in large caps going long 2%, 5%, etc. of purchase stock value? Now, first of all, just a few things to clear up if you're a little bit new to the stock market and investing. Large caps are basically companies that have a big market value, like your Amazons, your Googles, etc. If you're a long-term investor, you're probably looking at least a year invested into a stock. And basically this guy was asking if a stock goes down 2%, 5%, where would you put your stop loss? And I'm just going to talk about my opinion on it first of all. So, first of all, if your stop loss is at 2%, you're pretty much going to be selling a lot of your positions like every week, and you would not be a long-term investor. And say at 5%, you know, if you're selling at that sort of stop loss percentages, your stock's going to get closed every single week, because at some point your stock is going to go down that much. It happens, and if I'm honest, if that ever happens into a stock that I really like, that's when I'm buying more shares, not selling my position. Now, if I invest into a company and I'm looking into a company and I really like a company and I believe in it long term, I'm not going to sell that company. I'm going to hold that position whatever happens. So let's take for example that I'm looking into Facebook, and Facebook did go down slightly, and I could say the same for Boeing at the moment. I'm probably Alibaba in my portfolio. It makes my portfolio sound terrible. But if I look into Facebook and look at the fundamentals of Facebook, we've got a P that's amazing. We've got growth that's still like 20% growth, and we see that they're going to be making more money from the advertising side of it, from all the growth sectors that they're in, and I can tell that Facebook as a company is going to be making more money in, you know, a year's time, 2 years time. So if the stock goes down a little bit, why am I going to worry when I'm sure and I'm certain that I know that company is going to be making more money in the future? So that stock market value is, or the stock share price is going to go up. It is a bit stupid to be selling it because I believe in that company, and when you have that sort of belief in a company, whatever happens to your company, whatever news comes out, whatever's going on, China trade wars, if you believe in that company, you know the fundamentals of the company and you know that value is going to go up, you have confidence, and when you see a red day or a heavy red day, you just go, yeah, I've took a bit of a hit today, but you know what, when I look back in a month's time, it's, you know, I'm going to be okay, I'm going to have that money back, I'll end up gaining it, the stock will recover, and that's what happens overall, guys. Now, from that sort of thing, yeah, stop losses for me, I would not use, and I think this guy have to make this point about if you should use stop losses, and I'd say, you know, you believe in the fundamentals of the company, so you don't sell, and if it goes down that much, you look to buy into more shares and increase that position. But I think this guy pretty much said that he got burned previously in the stock market because he had companies that went up, and then he kept holding, and then eventually went down, and he lost all his gains, he didn't gain his money. And in that sort of scenario, is to avoid that, what I do is I always put a price where if a company shot up to that price, my fair value price I call it, that's where I would sell out of that position. So if a stock goes up crazy, you know, even if I believe it on the long term, it has that sort of run, I think, right, I've made my money, I like the company, I believe in the company, but when it shoots up like that, it's probably going to have a pullback at some point, and you take your money, you go invest in somewhere else, and you know, you try that company and maybe at some point you go back into it. You know, you've got to have that kind of where you know that you would sell out and you would take your profit. Obviously there's certain companies where you just let it run for a long time, but at the same time they probably won't have a big massive sharp increase. For example, like Microsoft is a company that I've held for a very long time. Boeing is one that I've had for a long time. I sold out after its increase, and then it had a bit of a dive, and then I got back into it because I like the company long term. Same with Alibaba, I've done it with Alibaba. You know, it's good to have a target with vision in that stock where you go, I believe in this stock, and when it gets that price, that's when I want to sell. Obviously, you can always update that. You know, I've done it with PayPal. I said I'd sell at $90 per share, But I believe in the company, I believe in the revenue increase, and I said, right, now I'm going to hold it actually a little bit longer. You can do that, but it's always good to have a bit of a re-evaluation and go, right, if I wasn't invested in this stock, would I still get into it now at this price? And that's how I would avoid having that kind of like protecting your gains and just having a lot of re-evaluating if you're going to keep holding that stock and if you rebuy it at the price it's at. I find that's always really good. So that's kind of opinion on stop losses, guys. I don't believe in them. I wouldn't use them. You know, if you believe in that company, don't sell it. And if it goes down that much, that's probably a sign that you should be buying more shares in that company, because you're getting it at a cheaper rate after all. So guys, give the video a like. Thanks for all the support recently. It's been amazing. Subscribe, and I'll see you on the next video.